Wall Street is holding its breath today. Well, as much as a room full of caffeine-fueled traders can actually hold it. Welcome back to The Deep Dive, your essential shortcut to understanding these complex currents shaping our financial world. Today, we're not just dipping our toes in, we're plunging headfirst into the pivotal moment on the financial calendar, the Federal Reserve's latest interest rate decision. And the central question for you, our listener, is sharper than ever, isn't it? Will the Fed's first rate cut of 2025 be a one and done? Or are we looking at a domino effect that could truly reshape the rest of the year?
It's truly a critical juncture, Mark, and we've prepared a really comprehensive deep dive to help you navigate it. We've meticulously compiled, analyzed a wealth of information for you today. We're drawing from detailed reports on Fed predictions, the intricate ballet of market reactions, deep analyses of global trade dynamics, specific company news, and a broad sweep of crucial economic indicators. Our mission today, really, is to equip you with a nuanced, comprehensive understanding of what's genuinely driving the markets right now, and maybe even more importantly, what crucial signals you should be watching for next to, well, stay ahead.
Absolutely, Maya, because today, the overwhelming expectation, it's everywhere, right? It's for a 25 basis point rate cut, a quarter percentage point cut by the Federal Reserve. This would be the first easing of monetary policy we've seen since, December. So it marks a pretty significant shift. But what truly makes this moment so electric, I guess, isn't just the cut itself. It's the signals policymakers will send about future cuts. We're talking about a delicate balancing act here. They're trying to reconcile the complexities of a, frankly, surprisingly weak job market with this persistently sticky inflation. And all of this is set against a backdrop of, mounting political pressure on the Fed. It's a tightrope walk for them, definitely. And for us, it's a fascinating opportunity to truly understand the forces at play.
Indeed. It's a convergence of powerful forces, Mark, each pulling in a different direction. It makes the Fed's decision not just about the single immediate cut, but really about the entire trajectory of monetary policy for the rest of the year and, potentially beyond. It's like a chess match where every single move has profound implications.
Okay, let's unpack the central piece then. The widely anticipated rate cut. The core expectation, like you said, from pretty much every Fed watcher, every Wall Street analyst, is for a 25 basis point rate cut today, September 17th, 2025. And just to put that in perspective again, a basis point is 0.01%. So a 0.25% reduction. This isn't just any cut. It's the first easing we've seen since December, remember, after a long period where the benchmark rate has largely been held steady, somewhere in that 4.25% to 4.5% range for most of 2025.
Yeah, and what's truly striking here is the overwhelming consensus among traders. The probabilities were hitting like 96% for this 25 basis point cut. So this isn't just a minor tweak. It signifies a pivotal shift after holding rates steady for so long. And its ripple effects are profound, Mark. They touch every corner of the economy. From the cost of borrowing for businesses, for homeowners, to the potential returns on your investments. This single action by the Fed, it's meant to respond to these evolving economic conditions. They're trying to strike that delicate balance between fostering growth and maintaining stability. It's about more than just the numbers. It's about signaling, maybe confidence, maybe caution in the economic outlook.
Right. Now, if you want a real glimpse into the Fed's collective mindset, not just for today, but for the rest of the year, maybe into next year, you absolutely need to understand the dot plot. This is where it gets incredibly insightful, I think.
Yeah, the dot plot, for those who aren't familiar, it's this unique quarterly chart the Fed releases. Each dot on this plot, it represents an individual Fed official's anonymous projection for where the benchmark interest rate is headed in the future. Now, it's important to remember, it's not a commitment, right? It's not a binding vote or anything. It's more like a collective snapshot, a kind of aggregated wisdom, if you will, of where policymakers individually see rates heading over the next few years. It offers an invaluable peek behind the curtain at their varying economic outlooks and their policy preferences.
And the last one, the dot plot from back in June, that was particularly interesting, wasn't it? It clearly indicated a consensus, or at least a majority view, for 2 rate cuts in 2025. Now, that projection, of course, was heavily influenced by all the uncertainty swirling around then, potential Trump administration policies, tariffs, immigration, taxes, all that stuff. So the really big question hanging in the air today is, will this updated dot plot, the one coming out with the decision, will just confirm one more cut this year? Or, and this is key, will policymakers signal something more aggressive, maybe hint at 3 cuts, especially with 2 more Fed meetings still scheduled for late October and early December?
And that raises a really important point. How much definitive clarity will we actually get today from this dot plot? RSM chief economist Joe Brusuelas, for example, he voiced some caution here. He suggests that this sticky inflation, which, we'll dig into in a second, might very well keep the Fed from being overly aggressive beyond just the September cut. He specifically said that 3 cuts for the year aren't a lock, despite what market probabilities might be suggesting right now. His argument is basically that the underlying economic data, especially on inflation, doesn't quite fully support such a swift, aggressive easing cycle yet. The Fed, in his view, probably prefers to remain flexible rather than commit prematurely,
Yeah, that makes sense. And it brings us right to the core of the Fed's dilemma, doesn't it? That perpetual balancing act, its conflicting economic mandates. The central bank has these 2 huge, often competing responsibilities. First, maintain price stability, basically, keep inflation under control. And second, maximize employment, ensure a strong, healthy job market. The really tricky part, as we see all the time, is that these 2 fundamental goals often pull the Fed in completely different directions. It forces some incredibly difficult trade-offs.
Precisely. And right now, we are seeing a very clear, very pronounced tension between those dual mandates. On one hand, like you said, mounting evidence of significant weakness in the labor market. Just last week, jobless claims, a key indicator of layoffs, they surged to 252,000. That's a near 4-year high mark. A worrying trend suggesting increasing fragility. And then there was that recent significant revision. It revealed a staggering 911,000 fewer people were employed between April 2024 and March 2025 than they initially reported.
Wow, 911,000 fewer. That's huge.
It's huge. It's not just a downgrade. It's a substantial reevaluation of the labor market's actual health. And, to layer on more evidence, the New York Fed's Empire State Manufacturing Survey, it dropped to -8.7 in September. That was driven by a sharp pullback in new orders and shipments. So that's a clear signal of broader economic softness, extending beyond just the service sector.
Okay, so on one side, clearly a weakening labor market, but here's this counterintuitive, almost provocative idea that seems to be gaining traction, the jobless expansion thesis. This concept, I know JP Morgan has explored it quite a bit, suggests that stocks can actually rise even as unemployment figures increase. It sounds like an oxymoron, right?
It does.
But the logic is kind of compelling. Weaker job numbers put pressure on the Fed to cut rates. Lower rates then reduce borrowing costs, make capital cheaper, which lifts stock market valuations, right? Because future earnings look better discounted at a lower rate. And critically, slower wage growth, which often comes with a weaker job market, that helps fatten corporate profit margins, boost earnings per share. It's a seemingly bizarre dynamic, but apparently it's not without precedent. You saw parallels in the 50s, 60s, early 90s. Goldman Sachs even put it bluntly, framing a cooling labor market as a tailwind to corporate profits. It really challenges that conventional wisdom that you always need a strong job market for a healthy stock market.
However, the other side of the Fed's mandate maintaining price stability, that's proving equally, if not more, challenging right now. We've definitely seen a persistent uptick in consumer prices. Inflation rose 0.4% in August, building on a 0.2% increase in July. This sticky inflation isn't happening in a vacuum. It's directly connected to increasing tariff pressures. For instance, U.S. customs duties surged to a record $29.5 billion in August alone. A lot of that is due to President Trump's new reciprocal levies on various imports.
Right.
As many analysts are noting, these tariffs are increasingly feeding into inflation. They basically act like a tax on consumers and businesses. This creates a really difficult scenario for the Fed, doesn't it? How do you cut rates to support jobs without fanning the flames of inflation, especially when some of that inflation is coming from external trade policy?
Yeah, exactly. And that's precisely where that insight from former Cleveland Fed President Loretta Mester comes in.
Yeah.
She gave a really clear explanation of the Fed's thinking behind perhaps a smaller rate cut. She said a 25 basis point reduction lessens the degree of restrictiveness of policy, so it eases things slightly, but it's still restrictive and puts downward pressure on the inflation part of the mandate while also taking out some insurance on the labor side. It's all about finding that razor-thin balance, making a tactical move, not a sweeping one, a measured approach, trying to prevent a severe downturn without giving up the inflation fight entirely.
And adding another significant layer of complexity to this already tricky decision is the ongoing and pretty palpable tension between White House pressure and the principle of Fed independence. President Trump has been an exceptionally vocal critic of Fed Chair Jerome Powell, repeatedly calling him too late for not cutting rates sooner.
Yeah, I've seen that.
And beyond just criticism, he has openly expressed a clear desire to install his people on the board for more aggressive rate cuts. He's openly disregarding the traditional and legally enshrined idea of monetary policy independence, that the central bank should operate free from political influence.
And that influence is becoming very, very real right now, isn't it? The Senate just confirmed Trump's nominee, Stephen Mirren, as a Fed governor. That was an exceptionally tight 48-47 vote just days before this critical meeting. What makes Mirren's appointment particularly controversial, from what I read, is his decision to take a leave of absence rather than resign outright from his White House advisor role. That move, naturally, it raises significant questions about the Fed's actual independence and his ability to make purely economic decisions without, political considerations. And it's crucial to note, he will be voting this week. Interestingly, though, a federal court recently rejected Trump's attempt to remove existing Fed Governor Lisa Cook. So she's staying, ensuring her participation despite ongoing court stuff. This whole confluence of events really highlights the struggle over who actually controls the central bank's direction. Is political influence stronger than ever?
Right. And while analysts are widely predicting that 25 basis point cut, it's definitely worth noting President Trump's public expectation for a much bigger cut, clearly implying 50 basis points. This divergence in expectations between the market analysts and the White House just underscores the intense political heat the Fed is facing right now. It makes the communication today all the more critical.
Okay, switching gears completely, let's talk about how the markets themselves are digesting all this anticipation. Ahead of the decision, we saw U.S. stock futures kind of wobble and essentially stall through Wednesday morning. Looked like they were holding their breath. Futures on the Dow Jones, that's ticker YMF, the S&P 500, and the NASDAQ intuition, they were all, barely moving. I'm looking at the Dow futures right now, YMF, it's at 46,129 per euro, up just 0.02%, tiny. This widespread stagnation across the major indices that follows Tuesday's action, where the S&P, NASDAQ, and Dow all slipped back from recent record highs as the Fed meeting officially kicked off. It's a clear picture of a market just treading water, waiting for some clarity.
Yeah, this hesitant market posture clearly reflects that pervasive anticipation, not just about the rate cut itself, but maybe even more about the forward guidance Chair Powell will offer. What's increasingly fascinating, though, is how specific geopolitical events and policy decisions are creating these very direct, very immediate ripple effects on individual stocks. It adds another complex layer for traders and long-term investors to navigate. It's not just about the economic fundamentals anymore, it's about the daily headlines, too.
Okay, here's a prime example of that geopolitical impact hitting home. Take NVIDIA, ticker NVDA, and its escalating China challenge. The Financial Times just reported that China has effectively told its biggest tech companies, giants like Alibaba, not to buy NVIDIA's latest high-performance AI chip, the RTX Pro 6000D. This isn't just gardens. It effectively bans tens of thousands of potential orders. That's a significant blow to NVIDIA's lucrative China market.
Oh, absolutely. And that news caused NVIDIA shares to slip about 1.5% in pre-market trading Wednesday, an immediate reaction. What's crucial here is that this ban seems to go beyond earlier restrictions concerning NVIDIA's slightly older H20 chip. Chinese regulators apparently now believe their domestic chips have achieved comparable performance for many uses. That intensifies the tech competition, pushes for self-sufficiency over there. And this comes right after NVIDIA shares also fell Monday on initial reports of an antitrust probe in China. It just powerfully demonstrates how swiftly and directly these geopolitical tensions can hit a leading tech giant's valuation and market access. This isn't just about sales, it's about the long-term strategic game.
Right. On a more positive note, though, at least for one company, Oracle, ticker ORCL, its shares rose pretty impressively on Tuesday and Monday. This jump was largely due to reports about its central role in a preliminary U.S.-China TikTok deal. CNBC and others reported Oracle would continue its existing cloud services deal with TikTok, which is critical for the app's U.S. operations. Even President Trump hinted at the deal on Truth Social after those high-stakes trade talks in Madrid. So this agreement is now widely expected to be finalized this Friday during that big meeting between Trump and Chinese President Xi Jinping. A clear geopolitical win for Oracle, at least for now.
Then you have Tesla, ticker TSLA. That stock seems to be in a perpetual state of flux, doesn't it? Quite the roller coaster lately. CEO Elon Musk's recent purchase was at $1 billion worth of shares. That significant vote of confidence helped Tesla wipe out its year-to-date losses on Monday, and the boost continued Tuesday.
Yeah, quite a statement.
Definitely. Investors certainly liked seeing that. However, the company also faces news of a new U.S. auto safety regulator probe, this time into potential defective doors. It just adds yet another layer of complexity and potential regulatory overhang. It's a constant balancing act for Tesla. Investor sentiment, executive actions, unforeseen challenges.
Okay, sticking with tech, but broadening out there. Chinese tech stocks are having what some are calling a rapid rally.
Mm.
The Hang Seng Tech Index, HS Tech HHK, it surged to its highest level in nearly 4 years, up a remarkable 42% year to date. Companies like Baidu, Alibaba, SMIC, JD.com, they're leading the charge. Seems like renewed optimism in that sector.
Yeah, this robust surge in Chinese tech, it seems driven by a few key things. First, renewed bets on artificial intelligence. Investors see huge potential for growth and innovation in China's AI ecosystem. Second, maybe a perceived easing of tensions between China and the U.S., particularly around trade and tech. That's providing a bit of a tailwind. And third, growing hopes for actually monetizing these AI investments. What's really interesting is reports that China tech leaders are visibly re-accelerating AI spend on everything from large language models, robotaxis, even in-house chip development. They seem to be proving they can monetize AI faster than maybe some expected, and their valuations, despite the rally, are still seen by some as lagging behind their U.S. counterparts, so maybe more upside potential there.
Interesting. Let's quickly hit a few other notable individual stock moves making waves. Workday, ticker WDAY, that rose a solid 7% in pre-market trading Wednesday. That jump came after they announced a $1.1 billion acquisition of a Swedish AI company called Sana. It's a strategic move that also got strong support from activist investor Elliott Management, which holds a big stake and has been pushing for growth.
Right. Conversely, Hims & Hers, ticker HIMS, those shares dropped 7% on Tuesday. That followed an FDA warning letter. The letter cited misleading claims for its semaglutide products, the weight loss and diabetes drugs. It really highlights the volatility Hims & Hers has seen despite being up, 107% year to date? Massive run. Wow.
The company also carries a high short interest, around 30%. And it's a lot of people are betting against it, which can really amplify price swings when things shift.
Okay. And Warner Bros. Discovery, ticker WBD. That sank 8% Tuesday after multiple analyst downgrades to hold.
Seems like growing concern over the speculative nature of its recent rally. That rally was fueled by those rumors about a potential Paramount Skydance bid, remember? So investors seem to be pulling back now, reassessing the underlying value and future prospects in a really tough media landscape.
On a brighter note, tech giant Alphabet, tickers GOEG and GOG, it crossed the monumental $3 trillion market cap threshold for the very first time on Monday.
3 trillion.
Incredible number. This historic milestone was largely driven by a wave of analyst upgrades. They cited an accelerated product development cycle and rapidly expanding Gemini adoption in its big ads and cloud businesses, signals strong confidence in their AI strategy and long-term growth.
And in the IPO market, which has definitely seen its ups and downs this year, StubHub, ticker SPUB, is making a big entrance with its IPO today, Wednesday. The company's valued at an impressive $8.6 billion.
Oh.
Marks a busy autumn for new listings after that period where tariff volatility kind of slammed the door shut in IPOs. Its successful debut suggests a renewed appetite, maybe.
Seems like it. Now, shifting focus to commodity markets, gold, ticker GCF, has been on an absolutely incredible run, hitting all-time highs. It surpassed $3,700 an ounce for the first time on Tuesday, after already hitting a record $3,685 on Monday. This precious metal is up a remarkable 44% for the year. That's significantly outperforming the S&P 500's already decent 12% gain.
Wow, 44%. So what's behind this huge surge in gold?
Well, the primary driver seems directly connected to expectations of Fed rate cuts.
Oh.
When interest rates fall, non-yielding assets like gold just become inherently more attractive, right? The opportunity cost of holding them goes down. An easing U.S. dollar, which recently hit a 4-year low against the euro, also makes gold cheaper for international buyers, boosting demand. And then, of course, you have persistent geopolitical uncertainties. People want safe havens coupled with ongoing central bank buying. Those are also significant factors. Looking ahead, Deutsche Bank already has a $4,000 price target for gold in 2026. And Goldman Sachs is even more bullish, forecasting $5,000 if just 1% of private treasuries shift into gold.
5,000.
Yeah, it really reflects a shifting perception of risk and value globally.
Meanwhile, oil prices, WTI futures, CLF, and Brent crude, BZF, they saw a noticeable 1% jump on Tuesday. WTI got over $64 a barrel, Brent over $68. That spike was mostly due to Ukrainian drone attacks on Russian energy infrastructure, right? Raising those immediate supply shock worries.
Exactly. Tightening the global oil market. Plus, a potential Fed rate cut could also spur demand from increased economic activity globally, which would further support prices. But despite this recent jump, it's worth remembering both WTI and Brent are still down about 8-9% year to date. Reflects those earlier concerns about global demand.
Right. Context is key. Finally, let's quickly touch on Treasury yields. They tend to reflect expectations for future rates and economic growth. We saw them fall slightly on Monday. The 30-year yield dropped to 4.65%. The 10-year eased to 4.04%.
Yeah, and what's really compelling here is that U.S. Treasuries aren't just holding steady, they're actually leading global bond markets this year, returning a solid 5.8% in 2025 so far. This outperformance is driven squarely by those expectations of Fed rate cuts. As TD Securities strategist Prashant Nunaha put it quite nicely, the Fed isn't cutting into a strong economy, it's cutting into weakness, and this should form the basis for Treasuries to outperform.
Interesting point.
His analysis suggests that the safety and yield of U.S. government bonds look particularly attractive in a slowing economy, contrasting sharply with other global debt markets grappling with their own issues.
Okay. So with all these complex dynamics swirling around, Fed decisions, geopolitics, commodity swings, how should different types of investors, strategically approach today's Fed decision and the market environment it creates? For short-term traders, the advice seems pretty consistent. You absolutely need to watch that volatility. It's almost guaranteed to spike around the 2 p.m. Eastern release of the decision, and then again during Chair Powell's press conference at 2:30 p.m. Eastern. Expect those markets to move fast.
Yeah, definitely. And for options traders, this heightened anticipation makes it a prime environment for strategies like straddle or strangle setups. These are more advanced strategies basically designed for those betting on significant market moves, but maybe they're unsure of the direction up or down.
Right, betting on the move itself.
Exactly. A straddle involves buying both a call and a put at the same strike price and expiry. A strangle uses different strike prices. The key is capitalizing on that expected heightened volatility around major announcements, aiming to profit from the size of the swing, not necessarily its direction.
Got it. And for the long-term investors among us, those with a multi-year horizon?
Well, for them, patience, as always, is undeniably key, Mark. Even a series of rate cuts, while impactful over time, typically takes several months to fully filter through, into corporate earnings, influence consumer spending, generate a broader measurable economic impact. So, while today's decision is significant, don't expect immediate dramatic shifts in your long-term portfolio. Think in quarters, not minutes.
Makes sense. Now, if we connect this to the broader picture of investor sentiment, that latest Bank of America Global Fund Manager survey for September, it showed rising bullishness, right? Global equity allocations hit a 7-month high. Suggests growing optimism. But there was a note of caution, too. Average cash balances held steady at 3.9% for the third straight month. That level often signals investors might be running a bit short on dry powder, available funds, maybe getting a bit stretched.
Yeah, that's the interpretation. But here's an interesting nuance, as Beauvais strategist Michael Hartnett pointed out. Sentiment hasn't quite tipped into full-blown euphoria yet. Historically, that hubris point, which often acts as a contrarian sell signal, would typically involve cash balances dropping below 3.7% or equity allocations climbing over 30%. Right now, with 28% of fund managers overweight global equities, they're certainly bullish, but maybe not quite at that extreme point where you'd expect a major reversal just due to excessive optimism. It's like market with confidence, but perhaps not yet overconfidence.
Nuanced bullishness. But it's interesting when you contrast that with the underlying economic concerns, right? Because the same survey revealed that a striking 77% of fund managers now expect a stagflationary environment. That's sluggish growth, sticky inflation, and higher unemployment. A stark reminder of the economic risks lurking beneath the surface.
Right.
And furthermore, the long Magnificent Seven trade betting on those mega-cap tech stocks that remains the most crowded trade on Wall Street underscores how dependent the rally still is on just a narrow band of companies.
It does. Yet despite those signals of shakiness and the stagflation fears, there's a definite upward trend in S&P 500 forecasts. Strategists at Wells Fargo, Barclays, Deutsche Bank, Ardeni Research, they've all recently lifted their S&P 500 targets. They're citing several key drivers: resilient corporate earnings, that ongoing AI investment cycle, and the expected Fed rate easing as the primary catalyst for the market's next leg higher. So while caution is definitely warranted, there's also a strong belief among many in these fundamental drivers pushing equities further.
Okay, moving beyond the immediate market reactions and sentiment, let's look at broader economic trends. They paint a really complex, somewhat contradictory picture, don't they? Take the American consumer. Still surprisingly resilient, yet there's this distinct growing tendency to hunt for deals. August retail sales data showed a robust 0.6% rise, much better than the 0.2% expected. Indicates continued spending strength, even with a wobbly labor market and sticky inflation.
Yeah, and what's fascinating is digging into the details of that spending. You saw increases in specific categories like clothing, sporting goods, and especially non-store retailers, basically e-commerce. That all suggests a pretty strong back-to-school season. However, there's that crucial cautionary nuance. While overall spending looks strong, almost everyone is actively looking for deals. There's this lopsided dynamic emerging. More affluent consumers seem to be driving a larger share of the spending, while middle and lower income households are noticeably more cautious, stretching their dollars, being more discerning. That bifurcation is definitely a key trend to watch.
And how long can that dual behavior persist, especially as external pressures mount? You mentioned tariffs earlier. We're already seeing tariff pressures becoming increasingly visible. Some retail categories, especially those relying on imports, are seeing actual volume declines. Households are struggling to absorb these higher prices, a direct impact of trade policy hitting everyday costs. Suggests that while resilience is there, it's being tested. That deal seeking could intensify.
Absolutely. Looking ahead, beyond today's huge Fed decision, there's a lot more on the economic calendar that will keep shaping market expectations. Today, Wednesday, besides the Fed, we also get new data on housing starts. That could give more insight into the real estate sector, which is super sensitive to interest rates.
Right. And on the corporate earnings front this week.
Keep an eye out for reports from food giant General Mills, ticker GIS, and the restaurant operator Cracker Barrel, ticker CBRL.
Cracker Barrel.
Yeah.
They had that whole abandoned Lodo change thing recently, didn't they?
Mhm.
Adds a bit of drama to the numbers.
It does. Beyond this week, we'll also see the latest weekly jobless claims that pulse check on the labor market and more manufacturing data. Plus, continued focus on mortgage rates, which actually saw their biggest weekly drop in a year recently. And as a critical proxy for global trade health, FedEx's earnings report will be a key bellwether to watch.
Okay, shifting our gaze globally now. One of the biggest events this week is definitely that highly anticipated Friday meeting between President Trump and Chinese President Xi Jinping. That summit's expected to cover a whole range of topics trade and, critically, finalizing that TikTok deal we talked about.
Yeah.
The outcomes could be massive.
Yeah, that meeting is undeniably critical because these tariff dynamics continue to be a major factor in global trade and market analysis. For example, U.S. tariffs on Japanese autos and parts were recently reduced to 15%. Now, that's down from Trump's initial 27.5%, but it's still way above the original 2.5% before the trade war. It just illustrates how tariff-related headlines continue to factor heavily into market analysis, impacting everything from supply chains to consumer prices to international relations. The trade landscape is far from settled.
Okay, here's something really interesting on the global corporate strategy front.
Yeah.
This emerging trend being called Indian startups de-risking.
Mhm.
Companies like Grow, a major fintech player, now set for an IPO, they're actively relocating their corporate headquarters back to India from the U.S. Grow even paid a staggering $159 million in taxes to make that move happen.
Wow.
And apparently other prominent companies like Pine Labs, Razorpay, PhonePeter are making similar strategic moves. It indicates a potential broader shift in global corporate strategy. Maybe companies are favoring domestic markets for regulatory reasons, access to local capital, maybe even nationalistic sentiment could reshape where future innovation is centered.
That is fascinating. Within other emerging investment themes, the relentless AI boom continues to dominate conversations everywhere. At that recent Goldman Sachs Communacopia Plus Technology conference, OpenAI CFO Sarah Fryer projected truly astonishing revenue growth, expecting it to more than triple this year, soaring from about $4 billion to $13 billion.
$13 billion from 4 in 1 year.
Monumental leap shows the explosive commercialization of AI.
And the demand for the infrastructure to power the AI is just overwhelming.
Completely. CoreWeave CEO Michael Intrater highlighted this overwhelming demand for AI compute capacity. CoreWeave, they're a specialized cloud provider. They inked an $11.9 billion 5-year deal with OpenAI back in March, then had to expand it by another $4 billion just in May.
Wow.
Intrater emphatically stated the depth of the demand, the scale of the demand, the breadth of the demand is overwhelming. This isn't just a trend, it's absolutely a hot trade right now. Companies are scrambling to secure the computational power they need.
Okay. Another evolving theme, crypto's gradual institutional shift. Bitcoin is hovering above $115,500, up about 23% year to date, even though September is typically weak for crypto. What seems significant here are observations from people like Eric Trump and Hut 8 CEO Asher Janut. They're highlighting crypto's increasingly global and institutional nature.
Sovereign wealth funds, major financial institutions apparently investing quietly, shifting the narrative beyond just retail traders to a more established market presence, Suggests some maturation, maybe. Could be. And we're seeing that clear IPO market resurgence we mentioned, signaling renewed investor appetite. StubHub's impressive IPO today, valued at $8.6 billion, and the successful debut of Swedish fintech Klarna last week both signal a busy autumn for new listings after that quiet period. Opens up new avenues for companies to raise capital and for investors to find new growth opportunities.
Right. Finally, there's that interesting, maybe provocative debate sparked by President Trump's proposal to shift from quarterly to semi-annual earnings reports. His argument is it would let executives focus on properly running their companies instead of just short-term results. Okta CEO Todd McKinnon offered a balanced view. He said while he appreciates talking to investors quarterly, the industry sometimes gets too obsessed with short-term numbers.
Yeah, I can see that.
He thoughtfully suggested reporting less frequently, but having more long-term strategic conversations could strike a better balance, potentially foster a more sustainable long-term approach.
Interesting debate to watch. So, Mark, to quickly recap this monumental day, we're looking at an expected 25 basis point rate cut from the Fed. There's that critical tug of war between labor market weakness and sticky inflation, all set against that highly politicized backdrop for Fed independence. We've seen varied market reactions, future stalling, specific stocks moving on geopolitics, gold hitting records, and we've laid out strategic plays, watching volatility for short-term traders, considering straddle strangles for options players, and patience for long-term investors.
Exactly. We're also keeping a very close eye on other immediate market movers for you. Today's new housing starts data, earnings from General Mills and Cracker Barrel, and, of course, those highly anticipated Trump-Xi trade talks scheduled for this Friday.
So grab your popcorn, or maybe your stress ball, because Powell's about to hit play on the markets, and the signals he sends today, well, they'll echo for months.
They certainly will. And for you, our listener, here's a provocative thought to chew on beyond this deep dive. How might this ongoing tension between central bank independence and explicit political pressure, combined with the accelerating pace of global AI investment and these evolving global trade dynamics, how might all that fundamentally reshape the long-term investment landscape in ways that maybe defy conventional economic wisdom? How should individual investors like you adapt their perspective from purely quarterly fluctuations to these broader foundational shifts? And what new metrics might truly define success in this rapidly changing environment?
And just a reminder, this deep dive is for educational purposes only and not financial advice.
Always do your own research before making trades.